how does the real world asset collateral differentiate DMM from the other DeFi projects and products?
Yeah, that's a great question. So the big thing that we see ourselves as one puzzle piece in the ecosystem, and we think the other interest earning and borrowing protocols that are out there are absolutely equally as essential as ours. So for us, what we're trying to do is bring stable, uncorrelated yield to the industry. And right now, a lot of the borrowing and lending that's been occurring has been happening purely based on the sentiment of crypto or where there's incentives that are placed right now. Right. So using the example of MakerDAO, predominantly the biggest CDP creators are individuals that are looking to leverage long for Ethereum. So if the sentiment for Ethereum ends up dropping, for example, because people think that the price of Ethereum is going to go down, unfortunately, what we've seen in the past is that it's very difficult for them to incentivize people to create CDPs then. And that's why MakerDAO has been looking to marry traditional finance and other uncorrelated assets into the ecosystem, because sentiment tied to what people think about Ether or the cryptocurrency space as a whole, which is quite strongly correlated with Ether, can be quite detrimental and quite a problem in some situations. The DSR, or the DAI savings rate, is one such example where initially the interest rate was very high, it was quite juicy, but eventually it came all the way down as soon as they realized that, well, not they realized, but the ecosystem had to vote in less expensive interest rates because people weren't willing to pay that much when the sentiment towards Ether went down. So this is where we think DeFi Money Market can, for example, come to play and play quite nicely, because when the sentiment goes down for the market and therefore people don't want to necessarily pay the interest rates and the interest rates go down, we see ourselves as something that can stay quite stable for 12 to 18 months before new policy potentially needs to come into play. But even before then, we'll be able to predict out quite easily, because at the end of the day, our assets and the backing of the ecosystem is not just backed by assets, but it's contractual relationships that form the glue around the assets. And those contractual relationships tend to extend out 12 to 18 months in term. And therefore, we can predict out quite reliably and stably what our interest rates will be. So variable rate interests are just as important as stable rate interests, and they both play together in different ways. So we think that the stable interest rates are where we come into play and can be quite different.